When people think something is a bubble, it isn't.
Oh.
You follow with a bubble, and there's a real bubble, people see it as purely an opportunity. If Samsung and Skhainik's do something different than the smaller stocks, the index is going to have a lousy return. Are you investing in Samsung, or are you investing in the stocks of South Korea? People shouldn't think about investing only in their country.
If and when Fisher Investments decides to sell NVIDIA, what would trigger that decision? Okay, Mr. Ken Fisher, it's an honor to have you here. Okay.
It's an honor for me to be here.
Yeah, thanks for being here, really. Can you introduce yourself to the audience?
Yeah, I'm Ken.
Yeah, I think that explains everything because
Pretty much if they read some newspaper called Shosanilbu,
Yeah.
there's a business section and I write in it every month.
Right.
And I run an investment firm.
right, and it's a very insightful column, so I think a lot of investors will read that. Okay, so I'll go on with the first question. So, what are your thoughts about the tension between the US and Iran, and how are these, geopolitical issues influencing the market?
So, on the one hand, Iran is a very different Islamic country than the other countries in the Gulf. It has oil. It's got the third largest oil reserves in the world. It's not a very successful producer of oil because it's not a very efficient economy in the same way that South Korea is very efficient and North Korea is very inefficient at everything it does, and for different but similar reasons. And yet this conflict centers around two features. One, their desire endlessly to get nuclear capability to destroy the West, which is a religious issue for them in an extremist way, different than the way Islamics in other countries feel, which is a historical shift from when I was young, when most of the Arab states were hostile to the West.
Right.
Whereas today, most of the important Arab states are allied to the West. The Kingdom, the Emirates, Kuwait.
Right.
These are all for their own different reasons, and some of them similar to the reasons that South Korea is allied with the West. We can talk about that if you want, but that tension of Iran wanting nuclear creates this. But then there's this other feature, which is that Iran still wants to and believes it should have power over the other Arab states, which would be accomplished through control of the Strait of Hormuz, and that cannot be allowed to happen.
And so, how do you think the situation happening in the area is giving an impact on the market?
So overall, with the exception of what's gone on in a few places like South Korea and Japan, which are so dependent on oil from Gulf countries, the impact's been fairly minimal. First, these countries otherwise are not a big percentage of GDP. They're a small percentage of GDP. They're not big economies. They're not tiny economies, but they're not big economies. And some of them are tiny economies like Qatar and Kuwait. Iran is not a big economy. Iran is this other thing. It will resolve itself because first there's history and second there's technology. The history shows that energy-centric wars, of which we've had 8 in my adult lifetime, end with positive resolution in a 3-step process that basically runs the price of oil before the tension begins is a function of the cost of production versus demand for oil. The tensions that lead to war cause oil prices to rise before the war starts. And then when the conflict starts, that exacerbates the problem. Oil prices spike as capital markets price in worst case alternatives. And then the third step is capital markets finally figure out you might not get the best case alternatives, but you surely don't get the worst, and the price of oil comes down, natural gas comes down, and stocks rise. That may be what you've seen with the decline and then the beginning of a rise in South Korea. But on a global basis, the market's basically been pretty flat for the year. And interest rates have not moved much, just a little. And the fear is overblown Because at the end of the day, the technology that the West has on this topic, and I'm moving to a sensitive topic, but other than nuclear capability from North Korea, the technology that North Korea has otherwise to engage in conflict against South Korea is completely inadequate, because South Korea has the capability of Western gear like F-35s. And North Korea's got old Soviet gear. They can't begin to compete with that. The technology that Iran has is more like that. It's, other than the drones, which are little and annoying, like endless mosquitoes, it doesn't have anything to compete with Western firepower. So in the end of the day, when this evolves, either Iran yields the Strait of Hormuz because it has to allow free passageway for the benefit of the kingdom, Kuwait, the Emirates, Qatar for natural gas. It cannot hold them hostage. All of them now allied with the West, with the exception of Qatar, which is kind of neutral to the West. Or the war will be taken to the Strait, and therefore the Western technology will dominate in that conflict, which is what President Trump was talking about before. The nuclear weapon part's done, the other part's the Strait of Hormuz. Once that happens, you move back to a world of cost of production versus demand for energy.
So in your point of view, it's more like a temporary situation, right? So because
these wars don't go on very long. What I've said in my column is that energy-centric military conflicts never impact negatively the capital markets, the stock market, or the price of oil for long.
And also, you mentioned that you wanted to talk about the U.S. midterm elections in November, right? So, how do you think that the election in U.S. will impact both U.S. and Korean stock markets?
So there's a couple of parts to this. First, in America, you have midterm elections every 4 years, in between the presidential elections, same time, beginning in November. We have that going back for a very long history. In the last 125 years, there have only been 2 where the president's party didn't lose a little or a lot of relative power to the opposition party. Sometimes a little, sometimes a lot. Because the Republicans have such a small margin in the lower chamber of Congress, the House of Representatives, it's almost certain that the Democrats take that. They may or may not succeed in taking the Senate, where there's a somewhat larger margin, but still a small enough margin where they may. What does that do? What that does is something that people don't think about, because, for example, in America, Republicans tend to think Democrats are terrible, and Democrats tend to think Republicans are terrible. I'm talking about the politicians.
Right.
And what most of them can't get is that they're all terrible. And the fact is, they all want to do something. And what they want to do is always going to take something from somebody and give it to somebody else, whether it's money, property rights, regulatory, something. The people they take it from hate it more than the people they give it to like it, because that's the way people are.
Yeah.
And therefore, presidents know when they get elected, first, they don't get elected, they don't know a lot about politics, and they know that their party's going to lose relative power in the upcoming midterm. So all big legislation in American history, modern American history, happens in the first 2 years of presidents' terms. In the back 2 years of presidents' terms, that doesn't happen. I've written about this in the paper several times. What happens with that is, in the U.S. system, you have primary elections state by state, where you pick a Republican and you pick a Democrat to run against each other in November. As that goes on, both sides are appealing to their base, which is the biggest part of their party, and they do that with extremist rhetoric. The extremist rhetoric makes both sides afraid of the other side winning. And that creates fear during the first part of the midterm election year, and stocks tend to go slogging sideways with some volatility. That's what we're seeing this year in America. Then the midterm resolves that, giving some increased relative power to the opposition of the president, which means that after that, there's no big, important, scary legislation that passes just the day-to-day housekeeping that you have to do. Markets react to that with surprise, surprisingly, and stocks love that. The fourth quarter of a midterm year over those 125 years is positive 85% of the time.
85% of the time.
The subsequent quarter, the first quarter of the third year of a president's term, is positive 95% of the time. And the second quarter has been positive 89% of the time. Now, to the beginning of your question, the connection between the United States and South Korea, there's actually a fairly strong positive correlation between the United States and South Korea, the United States being, and most of the world, the United States being the biggest weight in the stock market. And that will help in the back of the year push Korea further forward, where South Korea's already had a great stock market year.
Okay. So there will be vitality and it will go sideways, but after the midterm election, you think it will go up, right? Eventually
It usually starts before the actual election because people can begin to see the outcome of the election before the actual voting happens.
Okay.
At this time of the year, it's a little too early to see, so both sides can be scared of each other. But by the time you get into October, it begins to get pretty clear what's going to happen with, there's a lot of polling. The polling isn't perfect, but it's not terrible. And you begin to get a strong sense of how it'll play out. And in that, stocks tend to start rising about that.
For the third question, during the dot-com bubble in 2000, year 2000, you introduced PSR rates.
No, long before that.
Long before that? But it was known by people at that time,
Yes.
right? It got famous by that time. And you famously said that hoping for stock prices to rise when PSR exceeds 6 is pure gambling. And applying the same metric today, how do you assess the valuations of today's mega cap tech companies?
So I've changed my views on all that topic. Subsequent to then, I've done research that shows that valuations aren't predictive for the market as a whole, whether high or low. I can go into that with you if you want as to why that's true, but high valuation markets are not predictive of what will happen over the 1, 3, or 5 years ahead, no matter how you calculate.
So that's your point of view.
But
now.
I did not know that then.
Okay.
I keep learning stuff all the time. That's the fun part about life. That's the reason I keep doing what I'm doing. It's all fun.
And then, do you still hold the same conviction about your famous principle that this time it isn't different?
Right.
So
That's true.
It's true. You think that. The market will eventually recover from all the noise and events.
You were talking about Iran before, and all of those things. There are other things that people are concerned about, but this is a bull market, and there is nothing that's big enough to stop the bull market.
Oh, okay.
Eventually, the bull market will die. All bull markets die and get replaced by a bear market, which then get replaced by another bull market. But this bull market remains, on a global basis, firmly intact. Think about it a different way. If what's already gone on in Iran, and what's gone on with tariffs, and what's gone on with couldn't break this stock market, what's going to break the stock market?
Yeah, I think it couldn't for how long?
Oh, I don't know. I wouldn't go there.
Oh, okay.
I never really want to look more than about 2 years ahead at the most, and I really only make formal predictions once a year. But let me make a point to you. You remember I said that part about the second and the first quarter of the third year of a president's term, right after the midterms, and then the next quarter after that. If you take the third year of a president's term as a whole in the United States of America with the S&P 500, there hasn't been a negative third year of a president's term since 1939, and that was only down 0.9% for the S&P 500, which shows you the power of that midterm miracle effect and the elimination of the risk of major legislation hurting people.
So that's going to repeat again and
again.
A
little or a lot.
A little.
The reality is, and people struggle with this, both sides of the political spectrum think the other side's terrible, and they can't get themselves past that. They just can't get themselves past that. To see that the part that's terrible is when one side actually can do a lot. When they can't do anything, it's life goes on pretty well. You have a choice. Do you want more of what goes on in South Korea? Or do you want more of what goes on in North Korea? This is not a tough choice.
Right. And I'm not sure if you're familiar with the Korean political situation right now, but right now it's kind of like one party gets the all.
Yes.
So yeah, it's what's happening in Korea, and I don't think there will be like.
And there's problems associated with that concept.
Of course.
But then that could change.
Yeah, we'll see. Because like you said, this time it isn't different. Okay.
So people will always say it's different this time. And I didn't make up that phrase. John Templeton many years ago made up that phrase.
Right.
That the four most dangerous words in the English language are it's different now, or it's different this time. And the reality is it always seems a little different, and it never really is different. And then what people say is, but what about this? And but what about that? But what about the other? And as John Templeton also famously said, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. And all those yeah buts are, which I've used in my column, are ways for people to express that they're not that optimistic. They're not euphoric, meaning that there's still enough base for the bull market to continue. Another perfectly parallel function that I learned along the way is when people think something is a bubble, it isn't.
Oh.
Because if they think it's a bubble, that's a reflection of fear.
Oh, right.
And if there's fear, it can't be a bubble. You follow with a bubble, when there's a real bubble, people see it as purely an opportunity.
That makes sense because that's right what's happening currently right now. So from now we'll talk about the Korean market more specifically. So what is your assessment of Korea's major tech companies like Samsung Electronics and Skhainic's?
So first, if you think about those two, which are the two largest.
Yes.
And Samsung by far the largest.
Right.
And then a big step down from there to like Hyundai.
Right.
The reality is you still have the reality that the South Korean market cap weighted is very heavily industrial. Now, when you think about industrial, it's important to make the distinction about where do the industrials that are there fit into another trade-off. And that other trade-off is, are they perceived as growth stocks by the world, or are they perceived as value stocks by the world? Because there's a time when growth stocks do better, and there's another time when value stocks do better. This is a time when value stocks do better, and fortunately for South Korea, those companies are thought of on a global basis as value companies. Most of the array going down the cap spectrum, with a few exceptions of some financials, are basically industrials. And industrials in one way or another are being treated today as value, which is part of the reason that the South Korean market has done so well.
So you think that investing in value investing will continue for
a while.
A while. So
mind you, nothing goes on in leadership forever.
Right.
There was a long period where growth stocks did better.
Right.
To give you a comparison that doesn't relate directly and purely to South Korea, if you take the bull market that we're in, it begins in the fourth quarter with a midterm election of 2022. From that point, the Mag 7 in America got a lot of attention as what's leading the market. But if from that period, starting in the fourth quarter of 2022, you move forward and compare that to European banks actually did better.
Oh, really?
A simple statement of fact that almost no one understands.
Oh, okay.
Although, again, I've written about that in my column.
A question just popped up in my mind. So currently, recently, a lot of Korean investors are interested in SpaceX, which is, the space company of Elon Musk. And do you think that has as a growth investing or more of a value investing? You know, investing for space. You know,
It will be thought of as growth stock.
for growth stock. Okay.
But in reality, it's a whole lot of stuff. Let me put Elon Musk into a characterization that I don't think most people think of when they think of Elon Musk. With the exception of X, pretty much everything that he's done wouldn't work if it wasn't being subsidized by the government. Tesla, built on government subsidy. Electric cars in the name of climate change.
Right.
All of his functions that have succeeded, except for X, which is a different thing. Now, mind you, the public offering of SpaceX is much anticipated, and it has the potential for some other implications, but it'll be seen as a growth stock. Since it's going to be seen as a growth stock, I'd bet that once it goes public, it doesn't do very well.
Oh, okay.
First off, in an English language phraseology, and I made up this phrase decades and decades ago, I've always said IPO means it's probably overpriced.
Okay.
The fact is, initial public offerings are done when the cost of capital is favorable to the issuing company, not to the investor. And the history of initial public offerings is, while a few of them succeed very well, most of them end up becoming money losers. It's a kind of a sucker's game. It's kind of like going to casinos. You might hit it big, but you probably lose money. Because SpaceX is so big, it actually might be a sentiment indicator about the market as a whole when it goes public. Because if it goes up, that's a sign of positive sentiment. If it goes down, that would be a sign of negative sentiment.
So we're going to come back to the Korean market, and
Koreans are interested in the Korean market. I'm so shocked.
nowadays. They weren't before, but it started last year autumn, and
because the market's gone up.
Yeah, the market's gone up. It's, everybody said that the Korean market always betrays the Korean investors. That was like a phase that Koreans always say. But nowadays, everybody wants to go into the Korean market, and they're all interested because dollars are expensive for Koreans to change money because the exchange rate got high, and so on. So I think a lot of investors in Korea are now interested in Korea because there's some investors also like feeling FOMO because they think the Kospi will go up and so on. So that's the situation in Korea. And you've pointed out that investors shouldn't have acrophobia regarding the market. So do you also think that the Korean fear, but also this kind of goes opposite from what I just said, but there are also investors that have a fear for 5,000 and 6,000 points of Kospi. So do you think that concept is irrational, or do you think that you should
fear of
getting too high?
Fear of cosmetic barriers like 5,000 as a number.
Right.
That's nonsense. What's the difference between 4,900 and 5,100? It's nonsense. Fear of too high is reasonable, but what does too high mean? I want to go back to the John Templeton format. The reality is the Korean market will do better or worse than the world market. But in any country, in my opinion, whether it's the United States that has the biggest stock market in the world, or whether it's countries far smaller than South Korea, people shouldn't think about investing only in their country. It's a huge risk to invest only in your country. You should really think globally first. And if you can't find enough justification to invest globally, you shouldn't be investing in your own country.
No.
If you think that through. Over the longer term, while there's times where Korea will lag and times where Korea will lead, the fact is the world will move along pulling and pushing itself in pieces. And if you can't, you have much less risk investing globally. You should always think global first, your own country second.
Okay.
Whether America has the biggest GDP in the world and the most diversified GDP in the world, and is blessed in so many ways. And still, Americans should think about global first, U.S. second.
For American investors too.
American investors, German investors, French investors. The fact is, South Korea has been for a very long time an economic marvel. The history of the growth of South Korea's economy is just by itself a staggering statement. But sometimes what's going on with the economy isn't what's going on with the stock market. And the global stock market is moving to a beat of its own. And if I revert to what I said before, if you cannot find adequate justification in the global stock market to invest globally, and then maybe you want to overweight or underweight your own country, that's fine. But if you can't justify owning globally, you shouldn't be saying, boy, somehow Korea is unique and different. Okay. And we only want to do Korea. Any more than you should say you only want to do America. Let me take a second on America. America as a country is hugely overweight to growth stocks. In a period where growth stocks did well, like 2023 and 2024, America leads the world. In a period like 2025, America was one of the 10 worst performing stock markets in the 47 country ACWI index. It goes from the top to the bottom. Why? Because growth is so big in America. When growth leads, America leads. When growth lags, America lags. How do I say this most uniquely? You take the Korean market cap weighted. If Samsung and Skhainiks do something different than the smaller stocks, the index is going to have a lousy return. Are you investing in Samsung or are you investing in the stocks of South Korea? They're separate things in a lot of ways.
I think most of the investors are more focused on investing in Samsung and Skhainiks, not just about the overall, Korean market. Anyways.
Right, which is then that's two stocks.
Yeah, it's actually two stocks.
Exactly. Why not take all their money, just put it in gold like if they were in India, right? A lot of Indians do that, right?
Yeah, right.
And that, on the other hand, if you take this war, gold's gotten killed in this war. Is that the right thing to do? Not that owning some gold is a bad thing, but having too much concentration, do you really know that much? Are you really right? That takes a big risk, because if you're really wrong, you get hurt.
Yeah. We'll talk about, your investing philosophies, and
We kind of have.
yeah, but more about the past, or maybe like more fundamental ones. So your father, Philip Fisher, you yourself, and as far as we know, your son is also an active investor.
No longer.
He's not? No longer.
No, he doesn't. He's off. He makes and sells food dehydrators.
Food dehydrators right now. So he owns a company and okay. So then just only 2 generations. Okay.
Oh no, I have another son that's in the 401k business.
Oh, okay.
But that's not a global business. That's a U.S. business only.
Okay. So what would you identify as the most fundamental investment philosophy of the Fisher family? If there is one, or maybe it's different for everyone?
So what I would say most simply that people have a hard time with is that stock market reflects business. And business over time adapts and adopts all new science and technology to create improvements for people that had never yet been done before. Whether it's something totally new that people couldn't have thought of, like if you go out on the streets of Seoul, you'll see the taxis that were always there, but now on the side, most of them will say Uber. And the technology that derives through the Uber system allows the taxis to better serve people than what taxis did before, and helps the taxis get rides they didn't get before. Never yet done. Capitalism creates the never yet done. If that were not true, South Korea would be a lot more like North Korea, which doesn't allow for the capitalism. If that were not true, and then the pricing over time eventually captures the benefits of those never yet done things. Some of them are to do the new thing like the taxi Uber, and some of them are just to do the same old thing more efficiently than it was done before. So for example, when my grandfather was a young man, in America, agriculture was over half the total labor force. Today, America produces much more agriculture because of many never yet done things that allow them to be more productive with about 1.5% of the labor force. That all eventually gets built into the value of the stocks and therefore in the long term reflects progress. You don't get that progress off of a bar of gold. You don't get that progress off of a bond. There's volatility in stocks that makes a lot of people not like it, but of course you get volatility to some extent with anything that's liquid, but stocks are, volatile. But you capture the long-term innovations that then improve life for humans and you get paid for that. That's the most central point.
So if you sum up that, so your main philosophy would be to invest on technology that changes the world?
No. Yes and no. Often, and more the time than not, it's not the developer of the technology that makes the money. It's someone that figures out how to use it well. And come up with something that helps people that's never yet done before by deploying the technology to go do that, whatever that is. As opposed to the developer of the technology. Now, mind you, the developer of the technology is good, that's NVIDIA. Right? That's the process of developing the technology that creates the components. But if you think of what Uber did, they just created a simple app with an idea. That's not very hard to do. It's the idea that counts. And then the taxi just adopts it.
Right. Because it's already there.
Yeah. But mind you, the deployment of the technology, what you really want are the folks that adopt it and use it intelligently, not necessarily those that create it. If it was just those who created it, you'd just be investing in tech stocks.
So you should invest on the users who adopt technology.
To provide benefits to humanity that never yet been done before, whether it's in brand new services or enhanced versions of what was already done.
So it's interesting that you mentioned NVIDIA because actually my next question regards NVIDIA. So we see that investing in NVIDIA is like a symbol of value investing right now, like globally. And if and when Fisher Investments decides to sell NVIDIA, what would trigger that decision? And what specific, catalysts or conditions would prompt you to exist?
I don't know. I haven't gotten there yet. Let me just say that we're currently in a position where NVIDIA can readily sell every bit of output that it can make as it expands as fast as it can. When you get to a point where that's no longer true, the stock will do badly. I can't see what that is yet, but I can envision ways that could happen. Effectively, the biggest and obvious, most important one is things that create stumbling blocks for AI's deployment. Because that's the biggest single one, plus the things that go with that, the need for data center and what have you, and the semiconductors that go into that. In parallel, there's ASML, which is the lithography part, Taiwan Semiconductor. These are all ones that are doing really well because of the demand for all of this. Is when they no longer can sell every bit of output that they have at favorable prices because something's gone wrong with the demand. But what that is at this point in time, I can't tell you.
Your company runs about $387 billion.
406 as of this morning.
This morning, wow, you get updated every day?
Of course.
Every day.
Do you realize computers can do all those things?
Of course. And 406 billion, I'll correct that.
406.
406.
Not 6. That would be scary.
Yeah, of course, 406. And was selected as the best stock investment firm by Asian investors in 2025. So what's your secret?
When I was young, I learned this concept. It's a simple question. What do you do that your competitors aren't doing yet? And our secret is we're always trying to come up with new things that we do that our competitors aren't doing yet. It's an endless process. That's the secret.
It's just that easy, but nobody can do that.
Most people don't try. What most people try to do is to do best practices. If you think of best practices, that means that if you do it as well as anybody, you're good, but you're not different.
So you always have to try to think different.
The way you become best, the way you change the world is to do never yet done stuff, always. And of course, never yet done stuff gets old after a while. So you got to keep coming up with it. You know, one of the beauties of capitalism, and people don't think about this much this way, but if you go back to like when I was young and looked at the biggest stocks, it would have included Xerox, Eastman Kodak, Polaroid, poof, poof, poof. The biggest would have been IBM, which is still a material company, but compared to the rest of the world, it's much smaller than it used to be. If you went back to 2020, one of them would have been Cisco Systems. Still a significant company, but a mere fraction compared to others of what it was, because the new ones always keep eating up and taking share away from the old ones. They can't keep up because the old ones can't, they get arteriosclerosis in a sense as a business and can't keep doing never yet done things.
You hold the record as Forbes' longest serving columnist?
Yeah, except I don't write for them anymore. And I haven't written for them for a long time. But yes, no, I wrote for Forbes for longer than anybody ever did.
Yes, and you've also been writing a column in 조선일보's weekly biz for 7 to 8 years. So why do you place such importance on reaching investors through the media?
So the reality is, part of what I do is the investing part. Part of what I do is trying to teach people to see the world better. And effectively what journalism does is tries to get people to see the world. And so for me, it's always been a part where I'm trying to get people to see that it doesn't really work the way everybody says it works. It really works like this, and here's how you know that, and here's what you learn from that. And so for me, it's just, and you know, I'm a natural writer. I like doing it. It's fun. Remember what I said before, all this is fun? If it wasn't fun, I mean, I don't need to do any of this stuff, right? I could retire and go do nothing but play with my grandchildren. But then that gets annoying because they grow up, and once they grow up, that's no good, right? So, you know, you can only play with your grandchildren for so long.
This will be my last questions. Can you give some, any kind is okay, any kind of advice to the normal investors in Korea? So what should you do? What kind of thoughts you should have? Any kind is okay.
I was doing a seminar for the central bank earlier today and made a presentation and then took questions. And one of the questions was from a young man very young man, who said, I'm not very good at doing all this stuff. I've learned that I buy high, I sell low, and do you have any advice for me? And I said, well, there's a couple of old sayings. One of them is, the market is a place where someone with money gets an experience and someone with experience gets money. And there's another saying that if you don't know yourself, the marketplace is a very expensive place to learn. What happens is when you're very young, you don't really know yourself yet because the world's experiences with you as you get older teach you more about who you are. And so in many ways, the most important thing, one way or another, for any investor to learn is, who are you really? And where does that fit into investing? And that only comes with time. It is not something that you can get from reading a book and get it. Let me describe that differently. It's a little bit, but not, like boxing. You could read a book about boxing. That doesn't make you a boxer. You have to be in the ring to box. And if you've read the book, and then you get in the ring the first time against a boxer, you're going to lose. The negative part about being a boxer is you can only do it until you're so old. With investing, you can do it for a long, 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 long time. You can do it when your body doesn't work very well anymore. Like mine.
No. Okay, Mr. Fisher, I think this will be it.
Great.
I really thank you for your time.
Thank you.
Yeah, no, thank you.
You did a great job.